Let's talk about investing for a bit. If you've mostly conquered your debt, you're in the right place. If you are in your 50s and just starting to seriously think about investing, the clock is ticking, but this is far from over. In fact, the decisions you make in the next 3 to 5 years could completely transform the financial trajectory of the rest of your life. Personally, I think this is the most exciting phase of this journey. I've been working on my investments for a while now, and I have to say, there's nothing like the feeling of paying your first bill with dividend income instead of your paycheck. The fact that I was able to scrape together enough money to invest, to the point that my portfolio generated enough money to pay one of my bills all by itself, was mind-blowing. I didn't have to pay that bill anymore. It felt like someone else just took over the payments. Now I could use the money I previously paid that bill with to invest even more each month, and continue investing until another bill could be paid, and then another bill. I'm still investing, and I still have quite a few bills that need to be replaced, but the system is definitely working. All it takes for me now is a bit more time. And if I can do it, believe me, you can too. But here's the thing nobody tells you. There are some brutal truths standing between where you are right now and where you need to be. And if you ignore them, no investment strategy in the world is going to save you. So today we are going to rip the Band-Aid off, talk about what actually works, and give you a clear, honest roadmap for building real growth and income from your portfolio starting right now. Let's start with the hardest truth of all, and I want you to really sit with this one. Time is your most valuable asset in investing, and you have spent some of it already. The 30-year-old who starts investing today has a tremendous advantage over you simply because of the math of compounding. That's not meant to discourage you. It's meant to wake you up, because understanding this reality is what separates the investor who takes massive, focused action from the one who keeps procrastinating. You cannot afford to wait another year, another month, or frankly, another week. The good news is that people in their 50s often have something the 30-year-old doesn't have, and that is real income, real assets, and real motivation, because retirement is no longer an abstract concept. It's close enough to see. Use that urgency as fuel. We do need to talk about one thing regarding debt that is non-negotiable. If you're carrying high-interest debt, particularly credit card debt with interest rates sitting at 20, 25, even 29%, and you're also trying to invest in the stock market, you are essentially pouring water into a bucket with a massive hole in the bottom. The stock market has historically returned somewhere between 8 and 10% per year on average. High-interest debt is costing you 2 to 3 times that amount every single year. Paying it off is not just smart, it's mathematically the highest guaranteed return you can find anywhere. There is no index fund, no dividend stock, no magic investment strategy that will consistently beat a 20 to 29% guaranteed return. So here is the rule. Before you invest a single dollar in the market beyond any employer match you might have available, destroy your high-interest debt. Attack it aggressively, make it your obsession. This step alone will change everything. Now here's where debt reduction gets even more nuanced for someone in their 50s, because we're not just talking about credit cards. We're talking about car loans, personal loans, and even accelerating mortgage payoff in some situations. Every dollar of debt you eliminate is a dollar that is now working for you instead of against you. Remember to compare the interest rates on each one. For example, it doesn't usually make good financial sense to pay down a mortgage first at 3% when you can invest and make 8 to 10%. It would be smarter to invest to the point where your income can simply pay the mortgage for you, and when the mortgage becomes your very last debt, you can use any extra money you have, even from your job, if you're still working, to pay that down even faster. Every monthly payment you eliminate frees up cash flow that can be redirected into building wealth. Think about what happens when you eliminate a $600 monthly car payment and a $300 credit card minimum payment. Suddenly, you have $900 extra every single month to deploy into dividend-generating investments. The debt payoff is not separate from your investment strategy. It is the foundation of it. All right, so now let's talk about building the actual portfolio. And I want to be clear about what the goal looks like for someone in your position. You are building for two things simultaneously. You want growth to build your overall portfolio value, and you want increasing dividend income to eventually replace or supplement your work income in retirement. These two goals are not mutually exclusive, but you do need to be strategic about how you balance them. For the growth side of your portfolio, the most proven, most reliable tool available to an everyday investor is the broad market index fund. Invest in a broad market index fund like VOO or VTI for access to the S&P 500 or the entire US stock market. These instruments give you instant diversification across hundreds of companies. They carry very low fees, and over long periods of time, they have consistently delivered those historical returns we talked about. Disclaimer: I'm not a financial advisor. This is for educational purposes, blah, blah. I'm just a guy on YouTube. You know the deal. Do your research on specific investments that work for you and your situation. You're not trying to pick winners here. You're not trying to predict which company will dominate the next decade. History has shown us repeatedly that even the most dominant companies can fall from grace. The companies ruling the markets in the 1970s were largely replaced by different leaders in the 1990s, who were then replaced again in the 2010s. Nobody saw every twist coming. Index investing removes that guessing game entirely. Now here's a critical psychological truth about investing that you absolutely need to internalize. The market will drop. It will drop significantly at some point during your remaining working years, possibly multiple times. In 2008, the market lost over half its value. In 2020, it dropped sharply in a matter of weeks. Every single time, investors who panicked and sold locked in their losses. My sister did this exact thing in 2020. I tried to talk her out of it, but the panic just wouldn't let her go. After a few months, the market recovered almost completely. Needless to say, she was less than enthusiastic about it. Not only did she sell off the assets that were generating her income, it also triggered a sizable tax event she also had to pay for. Essentially, she locked in her losses by selling, and then paid a massive fine for that decision. Investors who stayed the course and kept buying saw their portfolios recover and eventually reach new highs. The single most destructive behavior in investing is panic selling during downturns. Research shows that missing just the 10 best trading days in the market over a 30-year period can cut your returns by more than half. You cannot afford to be on the sidelines when those big upswing days happen, and they almost always happen when things feel the worst. Automation is your defense mechanism here. Set up automatic monthly contributions and let the system work without your emotions getting in the way. This is dollar cost averaging, and it means you buy more shares when prices are low and fewer when prices are high, averaging out your cost over time. And if you have to, lock your phone and your computer in a drawer or a safe to prevent yourself from panic selling, because you can't afford to lose all the progress toward your retirement you've made during these critical years. The market will recover. It always does. Trust the system. Don't get cocky and try timing the market. Dollar cost averaging will get you through it, and you'll come out on the other side happier than a dog with two tails. Now let us get into the dividend side of this strategy, because this is where things get genuinely exciting for someone in their 50s. Dividend investing is about building an income stream that pays you simply for holding quality investments. There are dividend-focused exchange-traded funds that hold portfolios of companies with strong histories of consistent dividend payments and even dividend growth over time. These funds provide diversification within the dividend investing space. The compounding effect of reinvesting dividends back into your portfolio during your accumulation years is extraordinarily powerful. Every dividend payment you reinvest buys more shares, which generates more dividends, which buys more shares. And as you approach retirement, you can shift from reinvesting dividends to receiving them as income to cover your living expenses. Just keep in mind, you do not need millions of dollars for dividend investing to work for you. There's a big difference between investing in Johnson & Johnson or McDonald's versus SPYI or SCHD. The first is a type of dividend stock that does take millions of dollars to generate enough money to replace your income. The second are two example ETFs that only take between $500,000 and $800,000 to reach the same goal. Again, make sure you do your own research. Here's another brutal truth you need to accept. The amount you invest every month matters enormously. A small investment generating a 10% return creates modest results. A large investment generating that same return creates life-changing results. This is why eliminating debt and increasing your monthly investing contributions go hand in hand. The more aggressively you cut expenses and eliminate debt payments, the more capital you free up to invest. Someone redirecting $1,000 a month into dividend growth investments at age 52 can build a genuinely substantial income stream before age 65. Someone putting in $100 a month will see meaningful but far more modest results. Be honest with yourself about your numbers. Most of us grew up learning that every time you get your paycheck, the first thing you do is pay your bills, then you can buy what you need and want, and then save the rest. Or perhaps it was to sometimes save a certain percentage first if you could afford to, then buy what you need and want. The mindset shift here is critical. No excuses this time. You can't afford not to understand this key concept if you truly want to retire quickly. Pay yourself first, no exceptions. Buy assets that generate income and then use that income to pay your bills. It will be hard at first, and yes, there will be some sacrifice. But remember, you are only sacrificing for a short few years now to enjoy many more stress-free years in the future. You also need to take full advantage of tax-advantaged accounts immediately. If your employer offers a 401k with any level of matching contribution, that match is free money, and you should capture every dollar of it without exception. Beyond that, look at maxing out an IRA. If you're over 50, the IRS actually allows you to make additional catch-up contributions to these accounts each year, meaning you can shelter more money from taxes than younger investors can. These tax advantages compound significantly over a 10 to 15-year investing horizon. Every dollar you keep away from taxes is a dollar that stays in your portfolio and keeps working for you. Now I want to address something that trips up many beginning investors in their 50s specifically. And that is the temptation to take on too much risk chasing faster returns because they feel behind. This is a dangerous trap. Yes, you need growth. Yes, you need to be invested in dividend ETFs. But pouring your money into speculative individual stocks, cryptocurrency schemes, or complex financial products you do not fully understand is not catching up. It's gambling. And at this stage of life, a major loss is exponentially harder to recover from than it would have been at 30. Stick to diversified index funds and proven dividend holdings for your core portfolio. Let consistency and time do the work. Similarly, don't overcorrect by being too conservative. Moving everything into bonds or cash because you are scared of market volatility will virtually guarantee that your portfolio does not grow fast enough to serve you through what could be a 30-year retirement. With life expectancy continuing to extend, a 55-year-old today may well live into their late 80s or even their 90s. Your money needs to keep working for a very long time. So here's your action plan broken down into clear steps. Step 1. Immediately list every debt you still carry and rank them by interest rate, attacking the lowest balance first, or the highest interest rate first if you prefer, while making minimums on everything else. Step 2. Build a 3 to 6 month emergency fund so you never have to liquidate income-generating investments during a crisis. Step 3. Capture your full employer 401k match if one is available to you. Step 4. Open a Roth IRA or traditional IRA and take advantage of those catch-up contribution limits available to people over 50. Step 5. Set up automatic monthly contributions into low-cost, broad market index funds and dividend-focused funds. Step 6. Reinvest all dividends until you actually need that income. Step 7. Commit to never panic selling during market downturns. The investors who win are not the ones with the best stock picks or the most sophisticated strategies. They are the ones who eliminate financial drag, invest consistently, stay disciplined during fear, and give their money enough time to compound. Your 50s are not too late. They are actually your most powerful decade for focused financial transformation if you act with urgency and clarity starting today. I hope you got a ton of value out of this video, and if you did, please watch my comprehensive guides of financial freedom starting from nothing video, which you can click on right here. Also, please consider liking and subscribing, and drop your own thoughts and ideas in the comments. My name is Flint, and I will see you in the next video.